And under the chapter 2, financial system stability, we have discussed a lot of stuffs. It's a long chapter, and we are spending a big amount of money and significant time in this chapter. So this chapter give you understandings, fundamental things, and we have discussed a lot. And we have stopped at is we have stopped in the last class in this slide, and also there are some activities. Please go through this slide and try to get some ideas on this. Now we are going to discuss about the financial system stability. So before this slides, we talk about different components, different parties. So the basic ideas. Now only we are entering the core idea of this chapter, financial system stability. You know, stability mean there's no much variations, there's no much flexibilities. It's like a concrete, stable, right? Strong. The final strong system, It's mean what? The system is very strong. Now our scope is financial system. You know, I don't want to explain again what is financial system. We have discussed a lot of stuffs about the financial system. In the financial system, there are investors, there are depositors, intermediaries, banks, and regulatory bodies. And in the system, there are so many financial instruments like shares, preference shares, debt, bond. And there are a lot of things we have discussed. And also we have discussed the relevant act, laws and regulations, and infrastructure, and how the financial machine works inside. So we have discussed a lot of stuffs. So you are very clear about what is financial system. Now we are going to enter into the financial system stability, that we are going to talk about a strong financial system in the country. You know, you may find the kids always enjoy this kind of funny games, right? So if everybody make fun without any injuries, so they need what? They relies on what? Yeah. If time passes, it rotates very fast and fast. The speed of this rotation gradually increases, but people are realized. People are not, right? People are very. People are not afraid on this because they relies on the system. They relies on this system, right? So therefore, the peoples are be happy and happily move. They believe. So these are the different parties. If you consider it is as a financial system, there are many parties: investors, savers, depositors, borrower, banks, financial institution, financial market. Everything are related to this. So if the system want to be forever, it should be a stable system. Here in the system, it should be stable, strong. If the financial system is strong, all participants in the market are satisfied. They are safe side. If not, think about if there's small crack in this system, what will happen? So whatever the time, suddenly it will be breakdown, and many of them will be severely affected based on their involvement and the magnitude and vulnerability. Right. So the same principle will apply here. Financial stability. Financial stability. So in search of a definition. So now we think about what is the definition for financial stability. So luckily, there is no universally accepted definitions, right? Luckily, we don't have uh, universally accepted definitions of financial stability. It does not mean there's no definition for financial stability. Definition by various experts around abound, but most definitions are not amenable to qualifications. So there are a lot of different experts on financial system, and everyone, most of them are trying to give a definition. But the bad thing, the sad thing is those definitions are not comprehensive. It's a vast area. So everybody's of them are covering a particular part. So the word financial stability is a broad concept. Financial stability is a very broad concept. Financial system functioning without disruption. And system functioning without disturbance. It means without any disturbance, the function of financial system should work and return to steady state return. So people are invest in the market. People are realize to get return on the financial market. And if the market is stable, they will give a reasonable return for them. Reasonable return for them. So there are periods we may observe the market may encounter with some unstable period. Volatility. You know, volatility means what? There's more up and down every time. There are a lot of up and down. The up and down is very serious. Now in our market, uh, our Column Stock Exchange is volatile very severely. So recently I have done a study on that. Uh, so if you want, I can show you. Financial system functioning without disturbance, without any disruptions, and return to steady state. Steady state mean what? Return. So as I shown you, return is steady. But here, uh, when I show this picture, right here, uh, the returns are not stable. These returns are now stable, but in the COVID-19, during the COVID-19, the variability is high, right? There are a lot of shocks. There are a lot of volatility. We call it volatility in finance. So it's actual data about the financial markets. So that's why we are unable to attract many uh, foreign investments. We are facing very difficulties. Right. A financial system functioning without disturbance and return to a steady state. There's no much variability in return. After the periods of volatility, the COVID-19, the pandemic, it's a volatility. It makes volatility. It's make actually all over the world. It impacts adversely. Many markets, around the 90% of the markets, go down because real sectors like manufacturing, like garments, construction, most of the production side companies fall down. The performance are fall down due to the lockdown, right? So even though this kind of unexpected volatility, unexpected pandemics should not impact for a long time. So it is obvious, it is reasonable that due to that period only they can perform badly, but it should recover quickly. It should recover quickly, immediate, as in the reasonable period of time. That is the indicator of for the stable market. So volatility or vulnerability without significant impairment to the longer term prospect is generally considered an indicator of stability. So in this definition, we can find three things. Right. First one, there's no disturbance in the system. Think about the banking system. If the network is fall down, think about you have deposit 1 million to one of your saving account, but after 1 hour, 2 hour, you check the balance, it is not updated. Then you inquire the bank. Sometimes bank says our system has interrupted, disturbed, somebody else has hacked our account system, so therefore we couldn't receive your money in proper way. So what will happen? Sometimes you may make the transaction online. There's no evidence for you. So this time, think about the situation. If it's a good financial system, stable system, this kind of disturbance should not there. So it should not be there, right? So there's no disturbance and stable return. Stable return. If the market promises a certain amount of reasonable return, many people come and invest their money, and the market will grow, and country economic also grow. But the market not promises a reasonable return for the investors, many people are not come there. So it means it's one of the indicator of market instability. And in the period of volatility, like COVID pandemic, some in that period only it may affected, but it should recover for the good state in a reasonable period of time. So these are the indicator of good financial system stability. So volatilities mean the shocks, right? It makes high abnormal loss or abnormal profit. Volatility, abnormal, right? So volatilities within an acceptable or tolerable range can be represent state of financial stability. So think about Japan, US, Canada. They have well developed financial system, the well developed stock market. Even though the pandemic spread out there, the market was going down, but for a period of time. Then it recovers. Right? So even though those market having a strong financial system, there are a reasonable space for reasonable volatilities. But our economy is a miracle. Really, it's a miracle. All the world markets are going down, but our market is going up. So because of really speaking, what may be the reason for this? Action. The real sector will directly contribute for the GDP production of the country. Real sector. They contribute. So there are institutions, there are financial institutions, not only financial institutions, it includes the companies. They are involving, they are contributing the company's GDP. So institutions, it includes all the government institutions, regulatory agencies, stock market, right? they get everything, right, include. So it is the performance of financial institution impacts due to the macroeconomic conditions, the high increase of tax rate and changes in changes in inflation, changes in interest rate. So it will impact on the global economic condition. Global economic condition. In 2007, there was a global financial crisis. Due to that, our country economy also has adversely impact. Infrastructure, uh, CDS, Central Depository System, infrastructure, bank online network system, SLIP, right? So there are infrastructure and a market, stock market, other exchange market, right? So they have, all of them are interconnected. All of them are uh, impact on financial institutions, and not only financial institutions, it includes manufacturing sector, hotel, tourism, everywhere. So it's impact, and it will impact on directly real sector, right? Real sector, people are losing employment, losing income, poverty. Financial stability dimensions, it's broad, right? Dimensions, so broad and encompassing and forward looking. So we have to have a forward looking. We have to think about the future. Now we'll move the financial stability in detail. Financial system stability means a safe, safe, safety is important. Safe and secure financial system. Safe and secure financial system which able to withstand external and internal shocks. Internal shocks. Internal shocks. It is regard to for the economy. It arises within the country, within the economy. Say political change, government policy change, increases in interest rate, exchange. So this kind of stuff, things are internal shocks. Internal shocks. Increase in interest rate will impact on the market. External shocks. External shocks mean foreign countries. So foreign, say UK, China. Sri Lanka is closely Sri Lanka is closely maintaining relationship with China. So due to the pandemic, at the beginning, into the later part of 2019, China was almost locked down, especially Wuhan. And due to that, many materials are blocked. The transportation of the materials is come from China is blocked. So the disturbance, the shocks, the volatilities, the problems in China is impact on Sri Lankan system, Sri Lankan market. So financial system stability means safe and secure financial system which is able to withstand external and internal shocks. A stable financial system create a favorable environment. A stable system create a favorable environment for depositors and investors, encourages financial institutions, a favorable environment for depositors, investors, and encourages financial institutions and markets to function effectively and efficiently, right? So, and hence the promote investment in economic growth. If the financial system is stable, many people are willing to save their money, and many people will like to invest in the market. Due to that, many entrepreneurs are come forward to start a new business, and they are waiting for a loan. So they are getting loan, and they are making a loan. They will start new businesses. Many people get employment, and banks are run very efficiently. Financial intermediaries are getting more profit through the commission. and the economic growth is go up. Economic will grow up. So due to what? Financial stability. Financial system stability requires a stable financial and economic environment within an effective regulatory framework and safe and robust payment settlement system. Right? So this kind of financial stability will create when? So financial system requires stable financial economic environment. Stable financial and economic environment. But our country, it does not have in both financial and economic environment. You know, the government, so this government has introduced good systems, for example, and the new government will change this. They introduce another system, right? So this government is restricts, make restriction on import. The same thing was happened during the period of uh, Srimao Bandaranaike before 1972, I think. She has closed the economy and uh, she has promoted internal production, local production, and economies that time our country, our people are facing a lot of difficulties in that period because she has introduced in suddenly, right? But anyhow, many people are start to production in Sri Lanka, but the peoples are what do you call peoples are not happy of that. Financial system stability requires stable financial and economic environment. So within an effective regulatory framework and safe and robust payment and settlement system. So in our country, we have a strong, robust payment and settlement system, and also we have moderate regulatory framework. But the thing is, we don't have a stable financial and economic environment. The maintenance of financial system stability entails identifying and addressing potential vulnerabilities and risk to the financial system, right?